wow, I've never seen it this defensive for the last 10 years. Your initial reaction to all of this?
Well, look, it's a parade of horribles when you look across the different measures in the survey. You had, low growth expectations, low profit expectations, the biggest drop actually in the growth outlook on record on a monthly basis, huge drop in both earnings and equity allocations. I mean, everywhere you looked, it was kind of like, look anywhere and you find a record. As we said, this is the most bearish since the crisis. Three things, I think, primarily driving the change, three things investors are afraid of right now. Recession and growth outlook is the biggest one. Trade war, politics, et cetera, is the next. And I think finally, impotent monetary policy is something investors are starting to fear more and more. And it was evident from this data.
The impotent monetary policy story is the one I want to explore with you initially. What are the big worries? That the Fed is out of ammunition, that the ECB is out of ammunition, or it just won't work anymore?
Well, I mean, clearly, policymakers, through incredibly unconventional policies since the financial crisis, have really failed to stimulate the kind of growth and demand-driven inflation that they wanted to see. So when you look at the Bank of Japan, low interest rates, maybe forever. You look at European Central Bank, maybe negative, maybe low interest rates, forever. And if the Fed were to join that club, I think that's sort of game over for the growth outlook for the developed world. That's what investors are afraid of. And so when we look at the survey data, what we find, investors think, when we ask them, what would it take for the Fed to cut interest rates and support equity markets think it takes a big correction, 10% or more, to get here. It thinks on trade policy, policymakers need 20% almost downside before they would act. And so that fear that policymakers won't support the equity market without a whole lot of pain, I think is driving a lot of these bearish allocations.
So Jared, we saw a growth scare in 2011, 2012. We saw one in 15, 16. We didn't see global growth expectations plunge quite like they did in this survey. Do you think things are overdone here? Do you think we're capturing too much defensiveness, too much pessimism?
We're always contrarians. When we see, for example, the cash allocation spike from 4.6% to 5.6%, when we see all these measures of defensive allocation, it tells us that investors are overreacting. It tells us that there's a lot of bearishness out there, and that's why, as contrarian bulls, we think this is an interesting time actually to get out of treasuries, to get into cyclicals, and really look for a big change.
Well, let's draw a line under that. It's quite amazing, the idea that the treasury market is the most crowded story right now. The biggest long at the moment is in the treasury market. It used to be US tech. That is quite a turnaround in the last couple of months.
Right. I mean, really, it's a shift from a secular stagnation portfolio. Tepid growth, tepid interest rates. Let's find our barbell of tech for growth and maybe EM debt for yield. A shift toward a much more defensive, sort of classic recessionary type bunker mentality. If you do see, the price action this morning, one positive trade headline, and what does well? Tech does well. Consumer communications does well. So it's a shift back.
Well, underpinning the sentiment that you capture in this survey, then, how key is trade? And when the president tweets something like that, could this be a survey that flips the other way in a month's time on a good G20? Would that be enough to turn around things, just in terms of what you interpret is in this survey right now?
If we see, either more dovish language out of the Fed, real positive, meaningful, change on trade, there's no question that investors are positioned so bearishly that we would expect, a big reversal. Our bull and bear indicator, our broadest measure of sentiment, is just a hair's breadth from giving us a big buy signal that's been a remarkably valuable measure over the last 5 years. And just a little bit more bearishness this week would maybe get us there. I think at the same token, positive trade data would absolutely cause a reversal.
Is there an FX call in here, Jared, as well? Can you make one definitively? Because what is amazing about all of this, all this expectation for central bank monetary policy easing, G10 incredibly range bound through much of 2019. Can you make a big directional call in G10 right now?
It's very difficult, obviously, but what we do think is that the U.S. dollar has been much stronger than anyone expected. The survey this month, dollar most overvalued in history. It's very difficult to see how the dollar doesn't weaken from here, and that's one of the reasons we think that the bid for Treasury yields is actually going to dissipate this year.